Okay, picture this. Brand new cities with shiny skyscrapers and huge boulevards, everything you'd expect. But there's one thing missing: people. This is the reality of China's ghost cities, and they're this bizarre, surreal symptom of what might just be the biggest real estate bubble in history.
So that's the big question, right? Why on earth would anyone build a massive city for absolutely no one to live in? And the answer? Well, it's not some simple mistake. It's not just bad planning. It's actually baked into an economic engine that was designed to build and build and build no matter what.
All right, so first things first, let's get a handle on what these places actually are.
The term they use is guicheng, and I want you to really think about a place like the Kangbashi district of Ordos. We're talking a full-on modern metropolis built to house 1 million people, but for years, only a tiny fraction of that number actually lived there. These are fully functional cities, just waiting for people who might honestly never show up.
And here's the crucial part. These ghost cities weren't accidents. They weren't a miscalculation. They are the inevitable result of a system where the whole reason to build got totally disconnected from whether anyone actually needed a place to live.
So, what's the machine that churned out all these empty cities? Well, to get to the bottom of it, you really have to understand the weird financial bind that local governments in China found themselves in.
So, back in the 90s, there was this big tax reform that sent most of the revenue straight to the national government in Beijing. The problem? It left local cities holding the bag for all the expensive stuff. Schools, roads, infrastructure. Suddenly, they had this massive funding gap. And the kicker? They were legally banned from borrowing money directly, so they had to get creative.
And creative led them to invent these things called local government financing vehicles, or LGFVs. You can think of them as these kind of shell companies that let them do what they couldn't do directly: borrow massive sums of money. We're talking trillions of dollars collectively, all from state-owned banks. And what was the collateral? Land. The promise of future land sales. This one little workaround basically opened the floodgates for a tidal wave of debt-fueled construction.
And this created this incredible self-reinforcing cycle. Look at it this way. Step 1. A local official's career, their promotion, it all depends on hitting these high GDP growth targets. So, step 2. What's the fastest way to juice your GDP? Build something. Anything. So their LGFE borrows a ton of money to build, say, a new road out in the middle of nowhere. Then step 3. That brand new road suddenly makes all the useless land around it way more valuable. Step 4, the city sells that now valuable land to a developer for a huge profit. Step 5, that money from the land sale pays down the LGFE's debt and funds city services. And then step 6, the cycle just starts all over again. The incentive wasn't to meet demand, it was just to build to keep the numbers going up.
Okay, but wait a minute. All this construction needs buyers, right? So who on earth was buying all these empty apartments? Well, they found buyers, but not for the reason you'd think.
First, let's just take a moment to absorb the massive scale of this whole thing. At its absolute peak, the real estate sector and everything connected to it made up almost a third of China's entire economy. To put that in perspective, that is way bigger than what the US had going on before its own housing crash in 2008.
But it's not just some abstract economic number. It gets much more personal. For the average Chinese family, a staggering 70% of their entire household wealth was tied up in property. This wasn't just about the economy. For millions of people, this was their savings plan.
You have to remember, with strict rules making it tough to invest your money overseas, and a local stock market that most people saw as a casino, real estate felt like the one and only game in town. It was seen as the only safe, guaranteed way to grow your savings.
And this quote from our source material just hits the nail on the head. It says the housing market functioned less as a shelter provider and more as a giant state-backed mutual fund. That's it right there. People weren't buying apartments because they needed a place to live. They were buying them as a store of value, like investing in gold or stocks. And that's how you end up with the paradox of a huge housing shortage in one city and literally millions of empty investment-owned apartments in another.
So by 2020, the folks in Beijing were looking at this massive mountain of debt and getting, pretty nervous. They realized things were becoming dangerously unstable. It was time to slam on the brakes.
And they did that with a policy called the 3 red lines. Basically, these were 3 very strict financial rules for property developers. They put hard limits on how much debt companies could have compared to their assets, their equity, and their available cash. If a company was too deep in debt, if they crossed any of these red lines, they were cut off. No more new loans.
And you know what? The policy worked. It did exactly what it was designed to do.
It cut off the credit and starved the most overleveraged developers of cash. But in solving one problem, it triggered a massive crisis. The bubble popped. Huge companies that seemed invincible, like Evergrande, started to default. Construction sites all across the country just stopped, and a wave of panic washed over the entire market.
So, where does that leave China today? The country is now backed into a corner, facing this incredibly high-stakes situation with no easy way out.
Broadly speaking, you can see two possible futures. The first is what they're hoping for, a soft landing. This would be a slow, really painful, but controlled deflation of the bubble over many, many years, with the government stepping in to absorb most of the losses. The other path? A hard correction. That's a sudden, sharp crash in prices that could lead to a wave of bankruptcies and potentially full-blown financial panic. And really, to escape this trap for good, it's not about a quick fix. It requires rewriting the very rules of the economic game that got them here. They need to shift the whole economy away from just building stuff and toward actual consumption, getting people to buy things. And that means you have to build up social safety nets so people feel secure enough to spend their savings. They need a new, stable way for local governments to make money, like a property tax. And most importantly, they have to change the political incentives that rewarded officials for building ghost cities in the first place. You see, the ghost cities are just the most visible part of this whole story. They sit on top of a mountain of debt that, for 3 decades, fueled China's economic miracle. And now, the entire world is watching and wondering, can you really climb down from a mountain that high without a catastrophic fall?